Welcome to today's webinar on a really important topic for startup companies called Qualified Small Business Stock. And it's going to be a really informative presentation that is one of these areas that people may have heard about but not fully understand or appreciate the value that it could provide to a startup company. Just before we get into the actual topic, my name is Anthony Millen, and I'm the founder and co-chair of Next, powered by Shulman Rogers. Next is an innovative new model for delivery of legal services for U.S. and global startup companies. We offer a broad range of fixed price packages for startup companies for delivery of legal services, which provides a lot of predictability for seed to Series A companies. We integrate a lot of technology to help create a client-centric experience that's very collaborative, very efficient, and very transparent. We have access for our clients to seasoned senior attorneys and customer relationship managers, so a very strong customer service experience. And we also follow our mission of empowering startup success through our Next Raise platform, our Startup U, and our Pitch Masters program. And we've received a number of national awards, including Startup and Emerging Growth Company Law Firm of the Year by Legal Week, and a finalist for the most innovative law firms. So for more information on Next, please visit us at www.next.law. If you'd like to connect with us or speak with us, you can reach us at info@next.law. So today, as I said, we're going to be talking about qualified small business stock, and we have two of my partners who will be presenting today. We have Larry Bard, who is the co-chair of Next and also the chair of our securities practice. And we have Bob Cantor, who is the chair of our tax practice. And together, they'll be covering this topic. And now I'd like to hand it over to Larry and Bob. And thank you again, everybody, for joining us today.
Thanks a lot, Anthony. Just, Bob, as a technical matter, I think if you click that from beginning box on the top left of your screen, it should move the presentation to full screen mode and take away that strip at the end. But if not, that's fine. I'm gonna moderate today. My practice, as Anthony mentioned, I'm co-chair of the Next group. We are regularly advising early stage companies, founders on formation, things that arise between formation and a priced round. And on almost a weekly, if not daily basis, I'm running down to Bob's office, which is a few doors down, with a question about qualified small business stock, because it is an extraordinarily powerful tool to help minimize or avoid some types of taxes. So maybe Bob will start out, and I'm going to sprinkle in the questions that I get along the way here. But why don't you start out by telling us, please, what is qualified small business stock? What are some of the basics?
Yeah, as well, let me actually the basics. Qualified small business stock actually has been in the Internal Revenue Code since 1993. But all that said, it was rarely used until the last few years, because initially it provided for like a 50% exclusion of the gain on the sale of qualified small business stock. Now and even the excluded part was subject to the alternative minimum tax. So it provided very little benefit. But in a few years ago, it got expanded dramatically. It will enable a shareholder in a corporation, if they meet the requirements for exclusion, to exclude up to $10 million, the greater of $10 million of gain from the sale of the stock, or 10 times their tax basis in their stock. So there is a way to avoid tax, and qualified small business stock is certainly a wonderful way to do it. There are a lot of technical requirements, as you would expect with the Internal Revenue Code. The basics are the corporation must be a C corporation. You know, we used to have a lot of S corporations or LLCs taxed as partnerships that we were setting up for businesses. They would not qualify for qualified small business stock treatment. The corporation must not be essentially a service-oriented business, like a law firm or an accounting firm or a brokerage. There are some other prescribed businesses that can't qualify. We'll get into that later. And a key requirement, the stockholder itself must not be another C corporation. The stock must be original issue stock. It can't be stock that somebody bought from somebody else. They need to have bought it from the company itself. Key requirement particularly for startups that want to run up and have a sale in the not too distant future, the stock must be held for at least 5 years before sale. And the corporation itself must have been an active business for substantially all of the time the stock was held. And this one usually for startup companies isn't a huge problem, but the stock when issued in the corporation must not have had gross assets of more than $50 million. So we'll cover all these in a little more depth, but this sets the stage for how you can exclude gain on the sale of qualified small business stock. We'll turn first to C corporation status. If the company is an LLC, taxed as a partnership, and then elects C corporation status, it'll be treated as incorporating on the day it converted into a C corporation. The equity that the owners previously had in the LLC will become equity in the C corporation. And that's the date at which the 5-year holding period would start. Of course, the entity itself has to meet all of the other C corporation QSBS requirements. I would mention that there's sort of 2 ways to convert an LLC into a C corporation for tax purposes. One is that you file articles of incorporation and articles or a certificate of conversion, and that converts the entity that was for state law and tax purposes a LLC taxed as a partnership. It converts it into a regular C corporation. Another alternative, which is often used, is a very simple alternative of filing a 1-page election form with the IRS. And by filing that election, the entity continues to be an LLC for state law purposes, but it's converted for tax purposes to a C corporation. Simple procedure, but there's always a caution on that if they had an LLC agreement in place beforehand, usually has language that is partnership tax language, which is incompatible with being a C corporation. So if that elective conversion is done, it's important to review the LLC's operating agreement.
I'll just jump in here real
Sure.
You know, one interesting point is one of the topics we're often asked to advise early stage clients on is the choice of entity. Should I start as an LLC, which has certain advantages for tax purposes, or a C corporation? And of course, when you introduce a C corporation, one of the disadvantages is that if you're generating losses, they get stuck in the company and the individual can't necessarily take advantage of them on their own tax return. And there are other pros and cons of each, but one of the elements that's not on most of the lists when you look at the pros and cons of an LLC versus a corporation is starting your qualified small business stock holding period. So it is important for early stage companies when they're having this conversation with us or other counsel to consider, what do they think their exit trajectory is, and to weigh whatever benefits starting out as an LLC may have against the benefit. One of the benefits of being a C Corp is starting your potentially, if you meet the other criteria that you're going to be walking us through, is starting your qualified small business stock holding period.
No, that's a critical consideration. And certainly I know that we are setting up a lot, particularly in Next, a lot of the entities we're setting up as C corporations, particularly because of that consideration. What happens if you have an S corporation and you want to raise money and issue new stock? An S corporation cannot be a qualified small business. It has to be a C corporation, but an S corporation can terminate its S status. And what happens if it terminates its S status? Any newly issued stock after the termination of the S status can indeed qualify as qualified small business stock. On the other hand, the stock that was initially issued, typically to the founders, will not be able to be converted into qualified small business stock. Let me, and I'll add this one thing too. The corporation must be a U.S. corporation, not a foreign corporation.
That's great, Bob. I know your next bullet and your next slide is about disqualified activities, and I'm sure you'll walk everybody through, the list that's here. Occasionally we get a question about, whether a company's business qualifies, for the type of activities. I'm wondering if, as you're walking through here, Bob, maybe you could give an example of something that's close to the line, and something that might, in theory, push it over the line as being qualified or disqualified.
Sure, and that's when Larry walks down the hall and says, "Well, will this qualify?" And unfortunately, the IRS hasn't given a lot of guidance specifically under the Internal Revenue Code section that deals with qualified small business stocks. So you look at other provisions by analogy, and there are some rulings from the IRS and a couple from the courts. So you look at those as well. But the main type of business that's not qualified, and these are sort of commonly referred to as specified service trades or business, are personal service businesses. They're not selling widgets, but it'd be law, accounting, health, athletics, performing arts, financial advisors, brokerage services, engineering, architecture, consulting. And I'll get back to consulting in a little bit. Any business that, and you can look at what those are. Those are businesses where the personal reputation or skill of an individual is what drives the business. So that's a catch-all. Anything where personal reputation or skill is the critical element in the business won't qualify. Banking, insurance, financing, leasing, and investing also doesn't qualify. Hospitality businesses, and our firm represents a lot of them, restaurants and hotels will not qualify. Farming and mining, we don't have a lot of clients in that category, but they also are prescribed businesses. What happens if you have a business that's doing two things? One is a service business, and the other is selling widgets. That can create a problem because the way the rules are, if more than 20% of a corporation's assets are used in one of these disqualified businesses, the whole corporation cannot qualify for as QSBS. And it's 20% is determined by value, but the IRS gives you no real guidance on how to determine value. Value obviously can run a lot of different directions. It can be the cost of hard assets that are bought, but value of hard assets declines as they depreciate, or appreciates. Perhaps, if it was like, well, I'd say real estate, but we'll find real estate doesn't work for QSBS either.
Bob, just to go back to the last bullet point there, You mentioned there's a planning opportunity. So if you had, if you had in theory a business that you could bifurcate into two businesses, sometimes I show up in your office and you say, I can't do this. And I'm like, well, what if I do this, plan A and plan B concurrently? And sometimes you say the IRS will look at that all together. I take it this is not an area where there's a real planning opportunity here.
No, there is a planning opportunity, and we've used it on some businesses, perhaps not one I've worked with you, Larry, on, but certainly ones I've worked with other folks. And I'll give you an example. Well, let me first say, consulting is a broad term, and it's one that's not really defined, and it's one that often causes problems with companies we have. As to are they over the line or not. Generally, consulting is providing advice or analysis to your clients. And we have businesses, and this is an example actually we run into, where it's a company that develops software and then sells the software. But as an additional line of business in the same corporation, they were planning to provide consulting services. They'll tell their clients, well, here's the hardware, here's the software, even from other providers you need. That's consulting. That's because that's advice and analysis. So if it's all done in one business and the consulting portion is more than 20%, and again, it's real hard to determine what the relative values of the different businesses are, that business would not be able to qualify. So the planning opportunity is to create, you can't do it as a subsidiary corporation because subsidiaries are lumped together. You look through, their assets are considered the assets of the parent. But if you set up a brother-sister arrangement, so you have one consulting business owned by the same folks who own the qualified small business, that works. You got to watch out for loaning money back and forth because indebtedness isn't a bad asset to have if it's too much of a entity's assets. But that's the planning opportunity that is available here, and we've used it on a few occasions. So let's move on to the next.
That's great. And it's interesting, Bob, on your next slide, non-corporate stockholders. I think there's, when we say corporate stockholders, there's like the colloquial sense, and then there's the legal and tax sense, right? So if people might think of like, okay, you and I are individuals, we're not corporate, but we've got 5 venture capital firms, those are like our corporate shareholders. Like in some sense, maybe, but in your sense, not, right? Because most venture capital firms are not C corporations. They're usually some sort of an LLC or a limited partnership, which I take it because when we're on the company side or on the investor side, everybody's always very interested in, is this stock that we're purchasing qualified small business stock? I take it that a VC firm may very well be a qualified or a good holder, a good person to get QSBS treatment.
No, that's absolutely the case. So you can have any kind of pass-through entity, whether it's an LLC taxed as a partnership, a limited partnership, which many of the funds are, or for that matter, an S corporation. They can be a qualified shareholder in a QSBS. The taxpayer itself, really the bad shareholder is another C corporation. So this one is fairly easy to really determine whether you're okay or not. The original issue requirement is something that people can fall afoul of this by mistake. To be qualified stock, it must have been issued by the corporation itself. For a contribution of money, property, or services. If stock's purchased from another stockholder, it loses its QSBS
And let me
status.
just, Bob, I'm just going to jump in here a little bit
Yeah.
for a second. I mean, issued by the company, and the reason I'm going to jump in is we see a fair amount of people, show up in our lobby, and they've been, shall we say, DIY, doing it yourself on their cap table for some period of time. And when you look at their stock ledgers, to the extent they've got ledgers, or when you peel back the corporate records, you'll see, that it started out with founder one having shares, and founder two came later. And there's multiple ways to get shares to founder two, so that the two founders are 50-50. One way is the company issues the shares to founder two. That take it would be good QSBS, assuming all the other elements. The other way is founder one says, here, take half of my shares. And a lot of times we get these cap tables, and they're like bowls of spaghetti. The shares are going back and forth between the co-founders and the early employees, instead of cycling them, if you would, through the company. So I take it, Bob, if we did it, if founder one has shares, and maybe it's another issue coming that you'll come to later. But if founder one has 100 shares, and we want to make founder two equal, we issue founder two 100 shares. That's good. Founder one issues or sells half of his stock or her stock to founder two. That's not good. What if founder one says, okay, I'm gonna, forfeit some of my shares back to the company, and then those shares are going to be the ones issued to founder two?
If it's truly a forfeiture and there's no money paid for those shares, then it should work. But if even $1 was paid to the founder who's forfeiting shares, it's going to run afoul of the redemption limitation, which I'll cover in a little bit.
Okay.
Now, saying it's original issue stock, there are exceptions, and some of the exceptions are important. Stock that's transferred at death or by gift can continue to qualify as qualified small business stock. I'll mention this, it's just sort of a catch here. If stocks issued, which is very common, to employees as a benefit, they issue restricted stock to the employees. It's subject to vesting. And when it vests, the normal tax rule is it's taken into income by the employee. So you issue 100 shares to an employee, you say it's going to vest ratably over 5 years. Each time it vests, the employee must report the value of those shares as income. Even though they're holding the stock certificate from day one, the time at which the 5-year period will begin to run is when they're taxed on that stock. There is an election that a shareholder can make when stock subject to vesting is issued to them. They can elect to be taxed sooner rather than later. They'd be electing to be taxed when the stock is actually issued to them rather than when it's vested. Early stage companies, it's often a very good election for an employee to make, because they're going to be taxed on the low value at an early stage, whereas if it appreciates and in a couple of years is when it vests, the stock may be worth far more, and they'd be taxed on the value of the stock at the time it vested. The other real advantage of making that election is it starts the 5-year holding period running. I'll mention that if stock is held by a partnership, if it's distributed to its partners, it will continue to get QSBS treatment. And an S corporation, it's a little bit different rules for an S corporation, because, and this is one of the key differences between an S corporation and a partnership. If an S corporation distributes QSBS stock to its shareholders, that's normally a taxable transaction, and the appreciation in the value of the stock would normally be taxed at the time this stock is distributed. But if it's QSBS stock, you can use, and it's been held, I'm sorry, if it's and it's been held for 5 years by the S corporation at the time of distribution, then the exclusion will apply to the gain that's recognized on that distribution. Once that stock is distributed to the shareholders, it will no longer be QSBS stock, and any future appreciation in the stock would not get exclusion treatment. One thing, we have an awful lot of investors in early stage companies that are putting money in, but you don't really know the value of the company yet. So they put it in, and it's simpler. They put it in as a convertible note or as a safe. And Anthony and Larry know much more about safes than I do, other than from a tax viewpoint. If somebody puts money in a company in a return for a safe or a convertible note, the holding period for the 5 years doesn't start until the safe or convertible note is actually converted into stock. The same rule applies with respect to an option or warrant. The holding period starts when the warrant or option is exercised. And I mentioned earlier, with the forfeiture example that Larry posed, redemption. This is one of the catches that people sometimes trip into. If stock, there's two different redemption limitations. One is if stock is redeemed from a particular shareholder or family members, and then new stock is issued anytime within a 4-year period that starts 2 years before the redemption. I'm sorry, 2 years before the stock issuance. Then that stock can't qualify as QSBS. And the reason for this is to prevent an end run. It'd be the equivalent of one shareholder transferring stock to a family member, not by gift, but by selling it. There's an exception if the redemption is of less than 2% of all of the issued stock. The trap that people fall into more often is what's called the significant redemption restriction. If stock is redeemed, if stock is issued within a 2-year period, beginning 1 year before the significant redemption, then any stock issued in that 2-year window will not qualify for qualified small business stock treatment. Significant redemption is a redemption of more than 5% of the company's stock. Again, it's determined by value. So preferred versus common, you got to get the relative values of the two. There's a couple exceptions. Redemptions by go ahead.
There's two issues, that or 2 times the redemption issue comes up rather frequently. And I guess we always have to view it within this, the effect of that within this framework. But scenario number 1 that we seem to deal with, on a weekly basis is a co-founder dispute, and the result is that the company redeems shares from a departing founder. So I take it when that happens, if those that's over 5%, then shares there's the potential for shares that were issued within a year before that to be disqualified from QSBS, and shares that are issued within 1 year after that potentially not to get the treatment.
Yeah, that's correct, but there is an exception. So the exceptions are if stock's redeemed because of death, disability, divorce, and here's the one that might apply: termination of employment. If the founder's leaving and you're redeeming him, but he's still going to provide services, then there's a question whether there's really a termination of employment. But if it's, as you said, in your example, a dispute between the founders and it's get out of here, we don't, you're going to have no relationship with the company in the future, then it would fall within the termination.
That's great. I take it the other example probably is also squarely within that, and that's when, when an early employee has restricted stock, and restricted stock meaning stock that they actually own and can vote, but it's subject to redemption and investing and redemption, and if they leave before it's fully vested, typically the portions that are not vested yet are subject to being repurchased by the company or automatically repurchased by the company at par. But because that termination event is probably a termination of employment, those shares are not going to get caught up. Well, it's not really, that event is not going to be a triggering event for one of these disqualifying shares that were sold before or after it.
Correct. That's a good way to state it. And I'll mention one other point, that this is a temporary prohibition window. So once the 4-year or 2-year prohibition period runs because of a family redemption or a significant redemption, any further issuance of stock can qualify as qualified small business stock. 5-year holding period. Let me go back. 5-year holding period is an absolute time frame, and it must be held with 5 years before disposition. And we have seen cases where people will purposefully delay closing a transaction in order to meet the 5-year holding period. There is, I think, a couple cases or rulings with the IRS dealing, when does the 5-year holding period start? Because you may have a subscription to acquire stock, you may have money paid for the stock, but the actual subscription doesn't close for a while. So even though the money may have been paid earlier, it's going to be the date the stock is actually issued and delivered to the investor.
And
now,
Bob, I think you've been clear here, but I'm going to ask a question that we get occasionally. It's a 5-year toggle. So you hit the 5 years, you get 100% of it. If you're at 4 years, you don't, 4 out of 5 years or 80% of the holding period, you don't get 80% of the benefit. 4 years, you get 0, right?
You lose. Yeah, you got 0. As I mentioned, original issue stock can include stock that's transferred at death or by gift or by partnership distribution. The holding period is tacked on. So if a partner got or LLC member got stock distributed from the partnership or LLC, his holding or her holding period starts on the date that the partnership acquired the stock. Active business requirement. This one's a trap that a lot of people, I can't say a lot of companies, but some companies can inadvertently fall into it. And it's like some of the other provisions in this dealing with qualified small business stock, there's a fair amount of ambiguity or lack of guidance in it. The basic requirement is that at least 80% of the company's gross assets must be used in an active business for substantially all of the period the stock was held. And that's 80% determined by value. But unfortunately, the IRS doesn't tell you, number one, how do you determine value? Do you count intangible assets like the goodwill and going concern value of the company that hopefully will have grown dramatically from the time of original issuance? And an odd, well, I'll get to that later. And those specified service trader businesses are not considered active. So not only that's why, we mentioned no more than 20% of the activity of the company corporation can be a specified service trader business. Once you go over that 20%, you're going to flunk this 80% test. There's a pre-revenue startup activities do count as active, but you got to be careful because if you spend too long starting up the business. And it may be, and you've got funds in the business or that are not actively deployed in business, the IRS could determine that this is not really a pre-revenue startup activity. You're just dragging your feet and basically having a company that's holding cash or investment assets which are inactive. There is a tax court case. There's very few tax court cases on the qualified small business stock because it wasn't really used until a few years ago. You didn't get the 100% exclusion. But there's a tax court case where somebody's corporation that he tried to treat it as a QSBS. It was ostensibly set up to make and sell jewelry, but over a 2-year period, there was probably only 20 to 30 pieces of jewelry sold. And the court said, this is not pre-revenue startup activity. You just haven't really started the business yet in those 2-year period. And you're just basically holding funds that are not being actively deployed. Cash and other liquid assets are per se not active. However, there's large exceptions. Ones, as I said, it's the pre-revenue startup activities. If it's reasonably required working capital, that's actually considered active as opposed to inactive. If the funds are expected to be deployed within 2 years for research and development or anticipated increases in working capital needs, that's also considered active and not passive. And then there's an exception, after 2 years, you can only get 50% of your cash excluded under this provision. And as I said, there's a fair amount of ambiguity in this requirement. Substantially all is not defined. It's used in a lot of Internal Revenue Code provisions, and oddly, maybe not oddly, it is interpreted differently in different provisions. So it's fairly safe to assume that substantially all is at least 75%, but it may be as high as 85, 90%. We don't have case law on it. And it's substantially all of the assets must be used in the active business for the time that the shareholder held the stock. Oddly, if early in the life of the company, if the inactive assets exceeded the substantially all threshold, the stock would appear not to be QSBS. But we had this with another client recently. Well, they held the stock for 10 years. So the substantially all test is actually applied to the whole 10-year holding period. So even if they would have flunked in year 2 or 3, by the time you got in that situation to year 10, they were okay. Another limitation here, which is really a separate limitation, is no event more than 10% of the company's assets can consist, and its company's net assets consist of stock or securities of companies that are not 50% or more subsidiaries. And net assets are defined by, reducing the amount of the gross assets by indebtedness or other liabilities. And that is a trap that can be fallen into because the 80% test or the substantially all test all look at gross assets, but this looks at net assets. And there's another limitation, as I said, real estate. When I was using it as an example of appreciated assets earlier, I said, wait a minute, we can't do that in the QSBS because no more than 10% of the company's assets can be in real property that's not actively used in the business.
Bob,
The
I'm gonna jump in on
Yeah,
this
please.
one. Obviously, you know, the threshold is somebody that's got, if you're under $50 million in gross assets, you're good. If you're over 50 million in gross assets, you're bad, if I can use non-tax terms. You know, one question that comes up, somebody comes in and they say, you know, because of a patent they've got, or they've written some code, they've got some proprietary algorithms they're raising around, and their business is valued at $70 million. And they, you know, they might assume that because the company's valued, their assets, their business is valued at $70 million, they're no good. But you look at their balance sheet, and whether you're looking at a tax balance sheet or a book balance sheet, you know, it's you know, there's nothing recorded there. There's no actual assets.
Mm-hmm. And that's for the intangible value. And yes, and that's where the 50 million is somewhat of misleading, because what you look at is the tax basis in the assets. So at the time they were acquired. So if, you know, with a lot of our tech companies, most of our tech companies, they're not even close to the 50 million in gross asset value, even though, you know, and I know this is a question you've come up and asked me about, then, you know, the fact that the investors are investing on a pre-money basis of 70 million isn't what counts.
And the flip side of that, Bob, I see from your other bullet here, it's the original tax basis, not the depreciated value. So if I purchased a piece of equipment for a hypothetical $60 million, and it was depreciating, and I've taken 3 years worth of depreciation on it already, so my book basis and maybe even my tax basis at that point is under 50. What you're looking at is the original tax basis, so that would disqualify you?
Yes, that would, because it's original tax basis. The only time that it's not original tax basis is if somebody's contributing property to the corporation. What you use for contributed property is not the transferred basis, tax basis, because in a normal corporation, if somebody contributes property, the corporation takes over the tax basis of the contributor. And instead, if it's contributed property, you use the actual fair market value of that contributed property at the time of contribution, which, again, if you're really concerned about the $50 million limitation and you're getting contributed property that's quite valuable, and a patent might be an example of that, it's definitely best practice to get an independent valuation, because the IRS always has 20/20 hindsight to say it was worth more than you thought it was.
Got it. Very helpful. Before we move on to your next slide, there's a question in the chat, and I'll encourage people, if they have questions, to put them up there. But somebody asked the question of, you know, for when you're investing in a convertible note, and I'll elaborate, or a safe, does your holding period start when you do the note or the safe, or when it converts? And I think that, Bob, you said in one of your earlier slides, and if anybody's interested in getting the slide deck, shoot Lisa a message, or me or Bob, and we'll shoot it out to you. But I think you said that the clock starts to run when you do the conversion, not
Correct.
just investing in the convertible note or the safe.
Yep. Okay.
Which is really interesting, just to jump in real quick, because that has a profound, that question was from Kim over at Blue and Investors, and that's a big deal, especially considering that startups now are doing multiple rounds of safes and convertible notes, which, I don't know, Larry, what you're seeing in terms of that length, that could be an additional 3 to 5 years right before it even starts, right?
That's correct. That's correct. Absolutely.
So that is the downside of investing through a safe or a convertible note.
Yeah.
Okay, moving right along here. The per taxpayer limitation. This is the good news, because it's a high limitation. usually you hear, oh, you can just exclude $10 million of gain under the qualified small business stock. You meet all the other requirements, the qualified small business stock is disposed of. And that honestly, that can include not only a sale to a third party, you've gotten to the time of ending the corporation's life, you're going to sell it off to a third party, and you've got gain, and that would be excluded if you, again, it's qualified small business stock. But also, interestingly, applies to redemptions as well. There's bad redemptions, significant redemptions. We mentioned that. But if you've got past the 5-year holding period and the corporation redeems stock, the persons who sold their stock to the corporation can get qualified small business exclusion. In fact, I had a transaction I worked on over the past 3 years where a investor who was going to be the CEO of the company was brought in, and he was initially purchased 10% of the stock of the corporation, but the founders gave him an option and a put on their part as well to be able to sell the remainder of the shares of stock to the corporation when the 5-year, like right after the 5-year holding period ran. And we closed that transaction earlier this year, and it works. So that's where you can plan ahead to transfer stock. So what's the exclusion? It's one of two things, and it's the greater of the two. So as I said, usually it's thought of as a $10 million exclusion on the disposition of the stock. But alternatively, if it's greater, it's 10 times the taxpayer's tax basis in all of the qualified small business stock disposed of the taxpayer in a particular year. Normally, in our transactions, all the stock gets sold at once. It's not dribbled out in different sales per year. But if it's near the end of a year, this is a planning opportunity. And if the taxpayer has a significant basis in his stock or her stock.
And Bob, I'll note. I mean,
yeah.
I think you cover this in your next slide. And I'm not a tax lawyer. Maybe I'm a tax translator. And Bob's maybe the rare tax lawyer that doesn't need a tax translator. But when people, when tax lawyers talk about your basis in the stock for early stage companies, I mean, your basis is the amount that you paid tax on when you first received it. So when we form companies and the founders get that first share of stock and they pay a penny a share or 1/100th of a penny a share, or they make an 83B election and they say the value of the shares was 3 cents a share, the amount that they paid or the amount that the value of the stock was when they made their 83B election is going to be their tax basis. And so
correct.
For
it's usually, for founders, it's usually a small number.
Right.
For investors who come in later, it may be a significant number. So
Right.
you can have some of the taxpayers in a corporation, shareholders, wanting to use the 10 times tax basis calculation, and others are just the best they can get is the $10 million because their tax basis is low. And in most of our cases with tech companies, it's the $10 million limitation that comes into play. As I said, though, if you're using tax basis and it's near the end of the year, bifurcating the sale into 2 different years can dramatically increase the amount of the gain.
And I guess also, Bob, just to go back to your last point, and we don't need to get into all the details of estate planning, but this is a taxpayer limit. So if you're a married taxpayer, your spouse could also take advantage.
No, there's a special provision that if it limits it to $5 million if both spouses are trying to get the exclusion. But there's no limitation imposed on stock that's gifted to children or trust for the benefit of children. So that is a tremendous planning opportunity if you think you're going to, a shareholder is going to be exceeding the $10 million limitation, then the shareholder can gift stock to children and multiply the exemption amount. It's probably a glitch in the way the law was written, but practitioners are comfortable that gifting to children will multiply your exemption amount.
That's great. And that's very helpful. And Bob, I know we've been talking about this in terms of the amount of gain that's excluded from income. But if we were to translate the $10 million of gain at a 20% long-term capital gain tax rate, you're talking about $2 million of tax savings, I think, right?
Plus the state tax. People
Plus the state tax, which I know
the
is
state tax in Maryland, it's 8.95%. If you were in California, it's 13.3%.
Right, but just at the federal level, I mean, it's $10 million of gain,
Yeah.
which translates to generally, rough way of thinking it, of $2 million of taxes that you don't have to pay. Very, very sort of to end. I know you've got another slide and we've got a few more minutes, but that sort of is to summarize the very, very powerful nature of this benefit.
I mean, this is a huge way to avoid taxes. There are not many ways that, other than they say death and taxes. Death will avoid tax on depreciation, but nobody voluntarily chooses that one. I add another thing. If a taxpayer has gain in excess of the 10 million or 10 times tax basis limitation, two things. Number one is people got creative and said, well, we'll just contribute more money to the corporation to get us over, to increase our 10 times tax basis limitation. That doesn't work. The IRS says, no, if you're just pumping money into the corporation shortly before a sale so that the corporation will be worth more because it's now sitting there with cash, and your tax basis went up, that's a play that doesn't work. But there is another play. If you have more than this, 10 times tax basis or $10 million, a gain in excess of that, there is another provision dealing with qualified small business stock, and this isn't in the slides, but I thought I'd mention it. And that's a rollover provision. So you can roll over gain from the sale of qualified small business stock and invest it in other qualified small business stock. And you don't have the gain to recognize now. It'll just carry over into the reacquired stock, the replacement stock. The problem with this provision, which causes it to rarely be used, is you got to actually invest the money in the replacement qualified small business stock within 60 days. So unless you've got before the sale a target company that you'd be investing in, it doesn't work. What this really works for is funds that are taxed as partnerships, because they may use it and invest in other entities, even entities they already have an interest in. The other thing I'd mention about this rollover is it's available. The 5-year holding period does not apply with respect to the rollover. So if you have qualified small business stock and it's been held for at least 6 months, then the rollover provision can be used. And
that's great. I'm not sure we've come across that before, but it sounds like a real opportunity for serial entrepreneurs.
Yeah, I had one case in the past, I guess a year or so ago, and it was somebody who sold his stock and frantically realized he could roll it over, but he wasn't a serial entrepreneur and he couldn't find a replacement business in the 60-day window. But for serial entrepreneurs who may be invested in a number of businesses and some of which need additional cash infusion, because you're not just going to put the money in and not get new stock, it is an opportunity. I mentioned state tax. people often forget about state tax, but as you know, pointing out that Maryland's tax is at 8.95%, it's not insignificant. So a few states don't allow qualified small business stock exclusion.
I think, Bob, you went backwards on the slide instead of forward. If
Oops.
you just want to tap
Oh,
enter
yeah.
a couple times.
Oops.
There you go.
There we go. So a few states don't allow, and I think I mentioned them in the slide, don't allow the exclusion. California being a key one. So you're still going to get your 13.3% state tax on your gain that would be excluded if you were not in California. It might be a reason to move out of California before the sale. And interestingly, Maryland does provide the QSBS exclusion, but it didn't modify the QSBS provision so that the excluded gain is actually taken into consideration for Maryland state alternative minimum tax purposes. So you may even have some state tax to pay in Maryland on QSBS stock sale.
That's great. Thanks.
I think
Thanks
that
so
takes us
Yeah.
through the slides.
That's really great, Bob. Thank you. I know we've got a few minutes left here. If anybody has any questions they want to throw up in the chat, we'll keep the Zoom open for another minute or two if there are questions people have. And if not, I don't know, Anthony, you want to bring us home?
Yes, I want to thank everyone for joining us today, and big thanks to Bob and Larry for a tremendous presentation. And as I started off today and talked about the importance and significance of this topic, you can understand, having listened to it today now, why it's so important for founders to understand. And thank you again for joining us, and thank you, Bob and Larry and Lisa.
And I think, Anthony, at some point, the presentation will be up on www.next.law.
Yeah, we will circulate today's recording as well as the deck to all those who registered, and ultimately it'll be up on the website, our YouTube page, and Startup U. So lots of places to go back to refer it to.
Terrific. Thanks, Lisa.
Thank you, guys.
All right,
Great
everybody.
information.
Sure. Glad
Cheers.
to be of help here. Okay. Bye-bye.
Bye-bye.
Bye.